Hello, everyone, and welcome back to the world's best investing podcast. Thank you guys so much for your comments. That's what makes this the best investing podcast for me. The fact that you guys are here, you leave me all these nice comments, giving me feedback, giving me support. I really appreciate it. Thank you guys so much. And many of you guys actually asked me for a video about HIMS. And today I'm going to explain why I think this is going to be, intrinsically, in terms of its intrinsic value, a $2,000 stock by the year 2030. It fundamentally comes down to two truths, which is one, this is a company that's deploying a growing number of healthcare verticals, which are immediately accretive to free cash flow per share, fundamentally per management's ability to select verticals with a high ROI. And then the other aspect of the thesis, which is very important, is that the rate at which they are deploying new verticals is accelerating. And actually, if you see the acquisitions they've done over the past year or so, namely the last ones were the peptide manufacturing facility in the US. And then we also had the at-home testing kit, whole body testing company, essentially. Those two things are the basis for personalized healthcare with little to no side effects, because the healthcare industry is largely based on drugs that derive from petrochemicals. And so they are known to have side effects. The thing is, peptides are substances, essentially molecules, chains of amino acids that your body produces naturally. And so a lot of illness comes with age as your body stops producing these peptides. And so the function of certain organs, etc., deteriorates over time. Now, these peptides are very safe in the sense that, and by the way, this is not healthcare advice or anything. I hope YouTube doesn't ban me for saying this. But these peptides have a very appealing safety profile just because these are molecules that your body was producing naturally. So you're not putting anything new into your body. You're just putting stuff that the body stopped producing. And if you have an ability to test your subscribers, their whole body, while they're at home, cheaply, conveniently, without having to drive, through the traffic to get to the hospital, etc., then that's the basis for personalized medicine. Because essentially there's no limit to how many illnesses you can cure if you know exactly what molecules are missing in the body, and therefore where the illness stems from, and therefore you know exactly what molecules to put back in. And so that's the promise of this business long term. People are thinking about GLP-1 as if this were a GLP-1 company alone, and they are fundamentally mistaken to do so, because the growth of this business is coming from a number of verticals like dermatology, sexual health, etc., which are driving a lot of growth, a lot of retention, and are driving most of the business, in fact, beyond GLP-1s. But then the additional mistake is assuming that GLP-1 is really the end of the story for HIMS in terms of these kind of treatments where you put novel molecules into your body and it does something helpful for you. GLP-1s are a subset of peptides. The body has thousands and thousands of peptides, and GLP-1s are molecules, peptides that the body produces naturally. And so that business is really just the tip of the iceberg of what we're going to see HIMS doing over the coming few years. We're going to see them launching peptides for almost anything. There's peptides for sexual health, for dermatology like GHKCU, for longevity like epithalon, for the immune system like thymosin alpha-1, thymolin, and a bunch of other ones. I'm personally about to get on sermorelin and a few other ones that my peptide specialist recommended, because I did do a peptide cycle last year, and that was tremendous for me. It really allowed me to finalize my recovery from this health thing that I was talking to you guys about. Tremendous journey, tremendous. Very grateful for the adventure. Peptides work is the point. And as I was saying, if you think about it on a first principles basis, this goes way beyond GLP-1. It's going to be a multi-trillion-dollar industry, because people, once AI does a lot of the things that we do now, which are boring and take our time away and etc., people are going to have time and resources to really focus on other things which do add a lot of value to their life, like longevity, feeling good, being in great health. And there's no limit essentially to what peptides can help you achieve in that sense. So the point is that these two acquisitions have a fractal impact on HIMS's evolution, meaning that from those two platforms combined, we're going to see many verticals spring. And from these verticals, we're going to see other verticals emerge. And it's all going to be at a gradually marginal cost, because they have this infrastructure to essentially improve patient outcomes per dollar spent gradually over time in a way that's increasingly harder to replicate. So the thing with GLP-1s now is a little bit like wanting to analyze Amazon 20 years ago, or however long it was, that people were focused on books. And I think CEO Andrew Dudum made a great example about how back in the day, people were focused on whether Amazon was going to close a deal with whoever owned the rights of the Harry Potter books, and whether that was going to fall in one quarter or the quarter before, and therefore how analysts should be tweaking their models. And this is the same. It's a perfect analogy for GLP-1, just because it so gravely misses the point. This is an infrastructure that, in my view, is gonna be tremendous. It's going to be the basis for, I think, healthcare 2.0 in the States, and GLP-1s. People are completely missing the point. So the other thing about GLP-1s and all of these verticals that HIMSS is deploying is that they are generating proprietary data. So a lot of people are saying, they ask me, how do I get rid of my Teladoc PTSD? And the truth is that yes, Teladoc investors got hurt big time. I went in to look at why, and if there was any odds of the stock bouncing back up, just in case the fundamentals were actually strong. And no, the fundamentals weren't strong. Management wasn't focused on creating value. They just had a lot of data per the agreements that they closed with 50% of the Fortune 500 companies. They got all their employees on the platform, and so had a lot of healthcare data. But they didn't know what to do with this data. They had no idea. And so it's basically a value trap, Teladoc, and it will remain so until they have a management team that I think is properly incentivized to create value, and that understands how to use that data to actually improve patient outcomes per dollar spent. Now, HIMSS is the opposite. They started with no data, no moat, no facilities of any kind, and they've had to build everything on the fly, but they've managed to create a proprietary data moat, which is growing over time by focusing on improving patient outcomes per dollar spent. It's essentially the Costco/Spotify/Amazon algorithm applied to healthcare. They really only focus on delivering more value and doing so at a lower real cost. And generally, any company that exhibits a tremendous ability to do that, I think, is very likely to succeed over time. I explain this in my course. I call it the Costco algorithm. And basically, a lot of the successes we've seen over the past 2 decades are instances of the Costco algorithm applied to the digital space, leveraging network effects. Right. So as these guys deploy more verticals, they increasingly have more data about what kind of treatment works for what kind of individual for what condition. And so eventually that's going to create a data set which they can use to train an AI model that no one else has. And that's the long-term prize, the long-term bounty for shareholders, in my opinion, in this company. There's obviously risk, because what's fascinating is this is a venture capital kind of company in the public markets. So it's very volatile and so forth. We'll talk about how I get around this now. But basically, they're building this AI, which I believe is going to power the rest of the healthcare industry, because they have data that no one else has. And in the interim, the reason for which I believe it's likely that they do develop this kind of AI is that they have the ability to iterate on their infrastructure per the feedback that they receive from their patients/customers faster than anyone else in the industry. It's a closed feedback loop, which is really the first instance in the US healthcare industry and anywhere else, whereby they onboard, Andrew said in the last interview, somewhere between 10,000 and I think it was 25,000 customers per day. And as soon as they see these customers go through their first treatment for the first 6 months or something, they have additional intelligence in terms of they can calculate what the probability of something working for you is or not, and can therefore more finely tune the treatment that you get started off with. Eventually, of course, no treatment is going to work most likely at the first instance, but this sort of probabilistic model that they are developing allows them to better fine-tune the system. So as they achieve more scale, deploy more verticals, print more free cash flow per share, which they can reinvest, it just gets harder and harder to disrupt. This naturally begs the question, does this company have a moat? Because it's small, as I was saying, it's at a venture capital kind of stage. My view is it does, because if you look at what's happened in the past few years, we've seen Amazon announcing various entries into the market. I think they've done it like 4 or 5 times. And every single time, HIMSS stock went crashing, everyone panicked for a little bit, etc. But we just don't see them gaining traction. I believe there's a number of reasons for which this is happening, which I'll get into now. But then the other thing that caught my eye is that Walmart had to shut down their telehealth operation last year. And so what this shows you is that it's not easy to do what HIMSS is doing. These are 2 companies with vast resources, and they still don't manage to gain traction. Now, Walmart is an optimization machine. Of course, it's an instance of the Costco algorithm. Perhaps not. It doesn't work exactly in the same way. But my screen just went off for a minute. Yeah, there we go. It doesn't work in exactly the same way, but these guys failed to do it. Amazon failed to do it. If you look back at Amazon's history, you'll see that they faced initially many larger players than them that did try to make it into the e-commerce space and were meant to succeed. The consensus was that Amazon wasn't actually going to succeed, and still Amazon did it. It's because of the focus. It's because of the exclusive focus on a single task. Now, the focus by itself doesn't do anything. I could focus intensely on something and that wouldn't work at all. But it's the whole organization combined with the focus. So all the organizational properties that you want to see in a company, like a flat hierarchy, tolerance for bad news, tolerance for failure, an inclination towards experimentation, things like that. That is the moat. Now, specifically, if you want to see what I believe the moat looks like, if you look at Spotify, 2 years ago, people believed also that it had no moat. And they traded all the way down to, I think, $70. I bet really big on the company at $97. And the moat is that in the digital space, a marginal advantage in terms of adoption ends up translating into a marginal advantage in terms of user experience ends up equating into an exponential advantage in adoption. So when something is marginally better than the alternative, customers really... The opportunity cost for them is clicking a little bit to the left on the screen or a little bit to the right. So when customers have to choose between, say, Spotify and some alternative, that's literally the exercise they have to go through is, do I put my thumb a little bit to the left or a little bit to the right? So over time, as a user experience of a platform is better, that tends to equate to exponentially more users adopting this solution. And then what happens is that translates into more data, which then gives the company in question more insights to better serve these customers. And so if you look at Spotify, the number one thing that has kept them far ahead of Apple Music and Amazon Music, despite them having advantages at the operating system level, in the case of Amazon having a tremendous volume of subscribers, it's basically Spotify understanding slightly better than them what song you're likely to listen to next. And so over time, that has given them the bigger network, which has put them in a position to then deploy additional verticals like audiobooks, podcasts, etc. And then suddenly that has improved ARPU to the point that free cash flow per share has gone up exponentially. So what I'm seeing with HIMS is the same. I'm seeing extraordinary organizational capabilities just because the odds of them succeeding in achieving everything they've had to achieve in order to print this rapidly growing free cash flow per share were zero. It's not just that they are the first company to be operating successfully outside of the healthcare insurance system in the US, is that they've managed to do that while building their whole vertically integrated infrastructure on the go. They've been deploying verticals as they've been building their own proprietary facilities in order to personalize drugs for customers. They had to do that while building their app store, which simultaneously was ranking very quickly after launch. I think it was just a year or two after launch among long-time pharmacies like CVS and Walgreens, etc. So basically, the signs of excellence for this company are all across the board. And what I believe I was seeing, my takeaway from Walmart failing to do this and Amazon making many announcements and not really ever gaining traction, is that they don't have the unique focus on the healthcare business. And HIMS's exclusive focus combined with extraordinary organizational capabilities, which stem from extraordinary management, which in my view is the case. You know, I think Andrew Dunham is a great CEO, and I think a number of people that they have in the team are doing a great job. The combination of these two things just makes the business hard to disrupt. And so I do see a moat. I see a moat that's getting stronger over time. I believe it's going to get stronger, potentially even stronger than Spotify's, because if you break it down to components, HIMS's moat is essentially the same as Spotify, plus they have a large manufacturing component where they have to personalize drugs for customers in different geographies across a vast terrain, which is the US, right? So it's very hard to do. And so the combination of HIMS's moat, I believe, is going to be a combination of Spotify's plus that large component of manufacturing. And so I believe the moat is, obviously it's in formation. This is an 8-year-old company, as I was saying. This is a kind of VC sort of play. But I believe the moat is strong enough for Walmart and Amazon to be failing at doing this. And I believe it's going to get very, very strong over time. As it gets stronger and as this yields more proprietary data, I believe they give birth to an AI, which then takes this thing potentially even beyond $1 trillion in case of success. Because essentially what industries do is they process information, and in order to figure out what decision to take next in order to improve customer outcomes, or in order to improve their outcomes as a company, which sometimes is not really aligned with customers, right? And so if you create network effects in a given industry so that a lot of the data in the industry accrues to you, with today's technology, with data centers, AI, etc., that puts you in a position to do much of the intelligence work that the rest of the industry would be doing. And then that enables you to then resell that intelligence back to the marketplace at a lower cost, at a marginal cost. So that's really the business that these guys are going for. I believe that before 2030, all of HIM's subscribers have a personalized AI doctor, which is better than any doctor they could access today at their local geography. But I do believe that by then, this company has tens of millions of subscribers, and I believe that many of them, all of them essentially have an AI doctor, and then that AI doctor can be sold to any practitioner worldwide, really, in order to power their operations and make them more efficient. You can run the numbers whichever way you want, but I think that this does create a much, much bigger company. That vision, if you run rough numbers, it does take me to $1 trillion valuation eventually. And I think that, you know what's happening now? I think everyone is very focused on the tariffs and everything. But if you do think about it, we are in an AI revolution. It's obvious. The tariffs didn't stop Meta from launching Llama 4. And these models are getting exponentially more powerful. And we now have agentic AI and we have physical AI coming up. This is extremely real. And so I think people continue to underestimate the impact this technology can have 5 and 10 years down the line. Perhaps a little bit of overestimation over the past few months, but they continue to radically underestimate what's going to happen in the next 5 to 10 years. I believe even 3 to 4 years from now, the world is not really going to understand what's happened. I think that our children are going to grow in a radically different world. We're going to have to rebuild the education system, and we're going to have to rebuild many things, including our psyches, around this new technology, which is going to change a lot of things. Right, so this is the qualitative analysis that leads me to believe that this is going to be something valued in the ballpark of $2,000 per share intrinsically. And again, just to summarize, it comes down to the fact that they are launching a growing volume of a growing number of verticals. They are doing so at a faster rate, at a rate which I believe the market doesn't quite understand yet because it's growing exponentially, and it's going to do so as these new acquisitions kick in. Which, by the way, they have a solid track record of integrating acquisitions, so I believe it's going to do great. And then thirdly, the fact that this new technology, AI, is going to give them a tremendous advantage as they continue to compound on their proprietary data moat. So they have data that no one else has in terms of how do we make your outcomes better as a patient per dollar spent. And they have the economic incentives in place to do so, because the more deflationary they get, the bigger the network gets and the more money they make. So they have a deflationary incentive, which the rest of the industry doesn't. Now, just a bit of a word of caution. I've talked about this in a number of videos in the recent past. Excuse me. But essentially, what's going to happen is that because HIMS has positioned itself as the top of the funnel, that does two things. One, it disintermediates, it basically adds a layer of inconvenience to pharmaceutical companies in terms of distribution. Because up until now, they had unmolested distribution channels. They could do whatever they want, put whatever price they want to, maybe even don't have to do too thorough trials, because all that matters is that patients take the drug and then we can just tell them they're crazy if it doesn't work or if it causes side effects. Many of you guys will know what I'm talking about. So that's number one. And then number two, which is really a subset of number one, is it's highly deflationary for the industry. So they can't do whatever they want with prices now, because now you have this company that's scaling and is deflationary. It's like Uber to taxis, like Airbnb to hotels somewhat. Although long term, as you can see with these two companies, it's actually synergistic. But in the interim, what you do have is a little bit of a battle for that top of the funnel position, because distribution and business is freedom. And so GLP-1 is just the first instance of many in which I believe HIMS is going to go face-to-face with pharma and it's going to have a little bit of problems. Right, so I shared this in in the video, I think last week, in which I was reacting to the HIMS bear thesis that this gentleman on X shared. This is going to happen many times. So my view is that they actually have to confront a farmer as soon as possible, and in whatever form. It doesn't have to be to death or anything, but it does have to be in a way so that they build their muscles, their legal muscles, in order to get good at this. Because I can guarantee, I mean, GLP-1 is a disruptive drug. It's wonderful. It has many applications. Just wait and see until these guys, HIMS, start launching different peptides, which essentially render petrochemical-based drugs obsolete. It's going to be highly, highly deflationary to the rest of the industry. And so while I believe that is the way forward, developing their legal muscles, I believe there's a lot of risk in that too, because this is a company that's still not so large, and resources are important when it comes to legal battles. Of course, we have the admin as a tailwind, because their objective now is to make the US healthy again. They're not going to make investors healthy again if they continue plummeting stock prices like this. But I think they really do want to make Americans healthy again. I do believe, of course, that they want to make the economy healthy in the long term, because that debt thing was unsustainable, and I do believe that they are on the right path to fix this. And by the way, the latest tariff thing, I think, is the path to zero tariffs, because that's how you bring countries to the table. So I guess in terms of the economy, it's about dropping the tariff bill a little bit, or as much as possible, at their border, raising it a little bit at the US border, and then dropping rates. I think that's a good combination for making the economy more sustainable. But now, that's going to be deflationary peptides, and so I think we're going to see a battle per every time HIMS makes a move that's deflationary for the industry. Eventually, success for HIMS looks like essentially achieving a mutually assured destruction kind of scenario with pharma, as Spotify has done with music, etc. And then it becomes synergistic. At some point, it may actually become synergistic earlier if pharma understands that this makes the business bigger for them, because there's so many potential treatments that you can sell in order to essentially stop people from getting sick and have them live longer. That's a much better business than the current one. But of course, they're going to be focused on short-term profits, and this is not going to be good for the short-term profits, probably. Right, so I believe that this company gets much, much bigger. We had the recent stock price action all the way from 15 that I bought in to $72, and then back to 26, 27 now. But essentially, as I was saying yesterday, stock prices track free cash flow per share over the long term. And that's what's truly, truly important. So quarterly, as free cash flow per share continues to go up, because remember, that's ultimately what determines the intrinsic value of a share, I believe the stock price is going to do just fine, regardless of whether we enter a terrible depression or not. Because if we do enter a depression, we saw HIMS management in 2022 leaning in harder into the paid marketing when people were pulling back. That's one of the things that I loved about this management team. That enabled me to see that these guys are really capable of accelerating when things in the macroeconomy go wrong. So the macroeconomy, I think a bad macro has two impacts on HIMS, basically, which is one, cheaper advertising, and then the other one is essentially faster growth, because more people look for a budget solution for their healthcare problems. So I believe, it's the Costco algorithm. Costco does very well during recessionary times, and they gain market share just because people are looking for a better deal. And so HIMS gives people a better deal. And I don't think I don't think they compromise on outcomes. I think that HIMS is highly, highly customer centric, and eventually they're going to bring luxury healthcare to everyone. So I remain incredibly bullish. The price action has had no impact on my thesis. Of course, I have a relatively low average. My two big purchases are at $15 and $28, and I recently made a much smaller one at I think it was 37 or something. So I'm very happy with my average. I think it's going to do very well, and I'm quite excited to see what Q1 looks like, because I don't believe any of obviously tariffs haven't had time to have an impact on the HIMS earning yet, but I don't believe it's going to have an impact at all, a negative one. I believe it's actually going to be a tailwind. All right, so guys, thank you very much for joining me. As always, if you enjoyed this update, could you please share this with one friend? These deep dives are for free, and so the only way this grows is with your help. Again, guys, thank you so much for being here. Your comments mean a lot to me. I love reading them. I do take them into account in order to improve the video. So please keep them coming. And guys, I'm so looking forward. I'm really glad that you guys enjoy this format. I enjoy it too. It's kind of on top of my writings, which I read, etc., because those are the ones in which I really think about my thesis. In these kind of videos, I'm really just riffing, but it works for me because I'm reflecting real time and you guys get to see that. So I hope that you find it helpful, and see you guys next time.